Trader Mawira coming to you with another one. So I want us to study something. Let's get rid of the RSI for now. I'll show you some game with it. I want us to check out this day. This is 20th of December 2022 right here. Good thing is price repeats itself. So I want us to study this area, right? So you already know my start time is 10 a.m. PST. And then you know my famous pattern, or rather my go-to pattern on the 1 minute time frame. So I'm gonna just replay right there, so we just have some space here to work with, and I think that's good enough. So let me pull out my plan right there. Okay, there we go. Oh, that's the wrong one. I want us to pull the 1 minute time frame. There we go. So now you already know we have our short setup right there, long setup right there, and this is targets where the two share this. So this is targets. So now this one we are going short, right? So what we want is to see I know we're going short here. We want to see a high, and a higher low, and then a break of structure, right? Even before we're thinking of setting up the trade, which is the step two where we use the fib to set up our trade, and then our stop loss, and then our targets as below. So we do have a high right here. We do have a high. Let me get a little bit bigger, maybe go 14. We do have a high. You already know the drill if you watched my other videos. And we have a higher high, and then we have a higher low right there. Higher low right there. So as we advance, this is also like just one. This is one peak, though we have a high and we have one high there and another high right here. But this is now gonna, I will consider this as one peak. So all this is gonna be higher because now we're going deeper into this thing. So yep, there we go, there we go. So what we have is a high and a higher high, and then market declines, and then we have a higher low. I know you're like, why not this one? We're going deep now. And then we have the break of structure, which is right there, and that one happened, and we denote it with an arrow. Pretty much you can name it if you want to. Right there shows a break of structure on the bottom, on the middle. You can have it on the right, you can have it on the left, whatever you want. I think I like it in the middle. So right there we have a break of structure. So how we set up our trade from this point is we take our fib from the high, from the higher low to the new low that is formed, right? So we have this candle, we have the next candle is on top of that price, and the other is on the top of that price, and that's a new low right there. So if we have to name it, then it will be something like this. So just small n, that denotes our new low. And then this is how we would set up our trade. We just wait for the market to come back to 0.6, and then we have it on the higher low right there, and that's our first target, 80% off, and then we kill our trade. We close our trades right there. Now looking at this setup, because this is something I've seen over and over, as you can see, the market, it didn't retrace to at least, even if it's 50%. So to me, this is unfinished business, right? And you can see that we have a small gap right there. So this right here is unfinished business. So you might think that you missed a trade, but I want you to look closely at what price will do. So I'm gonna get rid of this plan right here. Hope you already took a screenshot if you needed to, or you can just rewind the video and see it for yourself. So looking at this price action, I really don't see anything that price should come for back here, because there's no fair value gap. Everything seems to be balanced, but here we do have something. After this displacement, we have this whole fair value gap right there. Is it a fair value gap or an imbalance? And then we have that gap. So if you're watching this, you can still set up your trade and just let it be, right? If you're afraid, maybe you can take it up a little bit high, or even go just all the way up. You're just gonna have like a small risk to reward ratio, but your trade is much safer, right? So let's say it crosses this high, then you can close your trade and not lose the whole risk. But for me, man, I'm a lone ranger. So this will be my setup right there, and then I want you to see something, right? So go, keep going, keep going, keep going. At this point we do have something here, but not really. Let's keep going, keep going, keep going, I want you to see something right there, right there. See? So now we are in. So our trade has now been engaged, right? So now we have done what price should have done. They just didn't do it immediately. And as you can see right here, we did leave some liquidity, if I could call it that. Those untouched highs, I'll call that buy side liquidity. And then we also have like a gap right here. So let me get rid of this. So you already saw the measurements, right? We can put that later. What we have here is an imbalance right there. I'll call it an imbalance or a fair value gap if you want to, I guess. And then we do have another gap right here. I call them gaps. I think people call them imbalances or whatever, right? And look what price did. It came in right there. So if you are a lone ranger, that would be a nice place to take that trade, and your stop loss just above that high, and you can go down to whatever low they set up here. But let's just stick to it and then see what happens. And the trade just pretty much goes down. So the thing is, everything met our plan, right? Everything in our plan was met right here. So let me see, we do have a text. Let me pull up that plan one more time. There we go. We're going short. So we do have a high and a higher high and a higher low right before we broke structure. And after we broke structure, this is where we set up our trade. But the market doesn't even retrace back to our 0 point. So that's the wait. Where did the new low go? Come here, boy. You're supposed to be down there. So the market did not even retrace back to 50%. So to me, I usually denote that as unfinished business, right? Where the market just sets that up for you to come and grab whatever orders might have accumulated right there, and now goes down as intended, right? So you can leave your order if you see such a thing. And I feel like this is too much, so you can see our entry as 0.62, and then now you can go back to your normal procedure, where if it gets down to 0.62, take out 80%, and then when it gets down to a full symmetrical swing, then close your trade. And this would have been a beautiful trade for you, even though you had to wait for the market to retrace back and come back for you. So not everything is not going to be by the book, but these are some of the variations that you're going to be seeing, right? And we need to note all that. So this thing happens a lot. It does happen a lot. Remember, it's after 10 a.m. PST, And then I want us to note something. This is another game that I want to give to you, right? As we advance. So I want us to go to like a 4-hour time frame because I want to show you something, right? We're going deep now, guys. No more chewing on some soft milk. So I need you guys to note every time you're looking at higher time frames. Let's say 4 hours in a 1 hour. I want you to note the last up candles before the market went down, or the last down candles before the market went up. In this case, I want us to study this one, right? So this was the last up candle before this market declined. So what I usually like to do is I'll take that lower wick and just denote it like that, right? Let me change the color of this one to maybe blue. Not that blue, maybe, yeah, that's okay, right? Maybe expand it a little bit so we can capture those angles, whatever. So there you go, and those wicks now become my support and resistance zones, right? Or I like to call them my staging zones or whatever. So what we have is, this is an order block, right? Because I think it is an order block. The last up candle before we declined. So what I like to do is I'll take that wick, right? Because price is gonna be somewhat sensitive to that low price in the middle of it, and also at the top, which is the open price of this up candle, right? It might even go all the way up here, but this is what we kind of anticipate for, right? So these are the kind of zones you need to mark on your chart, right? For example, I also mark this top wick right here, and as you can see, price also came down to that zone area, and then it went up, right? Or was rejected, as this was a down candle. Anyway, I want you to note this thing, right? So I'm gonna call it name it, I'll call it a 4 hour. I usually call it order block 4 bearish, because it's a bearish order block week, right? So what that lets me know is it's a week, and then the top is gonna be the open price, right? And I can put a fib to let me know that's the middle and that's the low price, right? So let's go back to a 1 minute, and this is where the game is. Right now you can see our setup, you can see where our setup is forming, right? At that order 4 hour order block week, at that resistance zone that I showed you that we got from the 4 hour. And we can just call it a 4 hour lower week, right? So our setup formed around the zone, and that to me makes up for some really strong setups, right? So when I see my formation happening on that forming on that zone, then I'm like, wow, that we might really get some good game. And you can see, if you were doing like support and resistance, when we left, this would be a retest of that zone, and we just left. Only that now you have a little bit more context, and you can get some really good entries on that support resistance zone, instead of just waiting for price to come to the resistance and then you're waiting for like a bearish engulfing for you to enter. You kind of have more context, right? Although all those things do really happen anyway. For example, this is a bearish engulfing right there. If you took it, that would have been something like this one, something like this, like that, and that would have been game for you. Beautiful. That's 3.37. So all in all, I think all strategies do work. You just need to get your own spot, your own feel of it, right? Just have a good trade management systems, because you still have losses. So this was that 1 minute imbalance, and this was that gap right there, and all this is happening in around that zone. So the top part is the 4-hour order block, the open price. So that's like the most sensitive area of all these three zones. That's what I would say, right? And you can see that top part is where the market goes on its way back to retest, and then it just shoots down, right? So that was pretty much what I wanted to show you guys, and I hope you've learned something. I'll give you something more extra. Let me see, let's just close all of this. And I thought this was really remarkable. Follow me, as this is something that really repeats itself, and it's right here. So this was at 12. Also guys, note the times, note the time. So this happened at, so the setup happened from 10, was setting up itself, and then the time to leave the ship was around after 11:15, and it goes. And if you go back to all the examples that I've showed you, all the setups did form around this area, right? The setups started, could have started earlier, but then the ship leaves the dock after 11. So kind of note that times. There's just something around. So the setup will either form at starting 11, everything from the high, low, and then the setup, the breaking structure, or the other setup for going long, and then the ship will leave. So now this one happened at around 12. So normally, okay, so let me show you something. This one also repeats a lot. It repeats a lot. I want to show you something. So we do have a low right there, and a lower low, and a breaking structure, right? And then look what happened. We left a gap. That's a fair value gap. That's an ICT classic ICT fair value gap. Shout out to Michael Huddleston. I believe that's Huddleston. Shout out to Michael. Now look what happened. Price comes and fills that gap immediately, and then we have another displacement. Now when I see that, I'll usually just confidently put my fib from that low to that high, and then my stop loss will always be below the candle that was the last one before we left, after the fair value gap is filled. It doesn't even have to fill the fair value gap. It would have just come to the middle or just a little bit and then left, and I'll put my stop loss right there. As you already know, my entry is usually 0.62 right there. My stop loss below, or just maybe a little bit your brokers plus your brokers spread, and then 0.62 I'm taking out 80%, and then 1 I am done with the trade. And this is why I told you that I like to take my profits just before I get to that spot. You see what happened here? Let's just put it exactly. This would not have taken you out because of your broker spread, right? So price would have been here, your broker, because of the spread, the price would have been here. So you, unless you close it manually, right? So that's why I like to put my take profit order just before. And then now this is what something else I want to show you guys. Market retraced and came all the way back, took out these lows, and then proceeded to just go up. And you're like, wait a minute. So let's say you're holding all this, and then you put your stop loss around there. The market came and took all the your and realized your profits, right? If you didn't take anything, takes them out and then proceeds to go up. And this would happen to me a lot, and I would be so mad. I'll be like, man, maybe I'm not a trader. Ugh, you know, you just start telling yourself all these things, but it's okay because such losses are there to make you a versatile trader. You learn from them. So now I want to show you something quite interesting, right? Now, I want to pull in the US 500 and we're going to compare the two, right? So I already did that. So we're going to compare the two. I hope you can see all this clearly, right? So this low, where is it? Where is it? Where is it? Okay, this is what we're looking for, right there, and right there. Let me do it this way. Oh, these people. Now look, you see that low? It's this low right here. You know, I'll put boxes so you can see that low is the same low right here. Now look what happened. US30 comes and takes out that low, but so that's the new low. Look at US 500. The low is way up over here. That low and that low, that low, this low. So this one is coming down. Well, this one is not coming down. And yet for me, when I see such such a setup, then I usually know that, you know, the market needs to go at least more than 172, so it doesn't have to. So in my head I'm thinking they coming down to take out liquidity, right? They would have easily still retraced to go down even further, but these ones, they don't even want to come down. The same thing happened with oh, actually this was US 100, right? The same thing also happened with US 500, where let me show you as well. Give me a minute. Up here, right here. So that first low is right here. Come on. That first low is right there. Then the second one is right here, right? So this one was taken out with this one, but this one was not taken out with this one. So this is what ICT will call an index SMT, right? Now, here's the game of how to take this setup. Note the last high before market declined. For me, in this case, it would be this one right here. Now you're wondering, why not this one? This is because to me, this week looks like it was just manipulation, right? It just, I don't know, I'll just avoid such long weeks. I'll just pretend that they're not even there, right? For example, and this high, I already put it there. So when price trades up to that area and crosses that high, I'm now ready to get back in sync with the market, because to me, the market is now going back up. And you know, when this happens again, I will show you on a live setup. It happens a lot. So in this case, this would now be my entry, because now if the others are not coming down like this one did, this to me is just searching for liquidity, or rather coming down to go up. So the moment they come back here, I am looking for just anything, right? There's nothing special about this. So your entry would have been once that closes at that low, or the low right here if you want to be a little bit safe, and then you can go back to now the full symmetrical swing one more time, or you can still hold it, or if you don't want so much, you can just, like, you know, wait for the market to, before the market just closes, for you to get out of this trade. So that would have been like a 1.7%. If you were a little bit more risky, that would have been an easy 4% gain. And if you held, you know, you'll now be looking at, oh, crazy, man, it just went up and up and up and up and up and up. So US30, I don't know, before they go up like this, especially if it's like a reversal point and it's the first time it's reversing and it's just giving you this smooth uh ride to the top, you might want to be skeptical about it, because they do like to come down and just clear all this and then now take the market up. So I hope that gave you some insight on this market. Remember, I only trade from 10 p.m. to the close of the market, so we're talking 3 to 4 hours, because pretty much after 1 p.m., after 12:55, the market tends to die off. Pretty much today it died off at 1:30, right? Like nothing happens, just small gains. So man, that was, I gave you a lot right there. I gave you a lot. And in this setup, if I was to bring in my my 1 minute plan, let's say, let's get rid of this. Let me come back to maybe right there. Let's get rid of this. Get rid of that. Rid of that. Let's pull up that plan. This is another variation that you can use. I know this didn't quite happen exactly, but you might want to back test, because what we have is we have a low, we have a low right there, we have a low. Let me put it a little bit bigger. Let's get rid of this, and we have a low, and then we have a break of structure right there, right? So now after the break of structure, we have a lower high. So what happens is if you're following these rules to the latter, then this one does not fit, because we need to see a low plus a lower low plus a low high before the break of structure. But in this case, we have a low, we have a lower low, and then a break of structure, and then a lower high, and the market proceeds to go, and then it starts declining, it starts coming down, meaning that this one was now the new high. Now at this point, I'll need you to go and back test, so you don't have to miss really nice trades. Now remember, we're not doing the order blocks and the fair value gaps, right? Because this right here is designed for you to kind of bypass those things and still get in sync with the market, and at the end of the day, get in as if someone who knew about the fair value gaps and the order blocks. This is kind of how this thing is designed around. So it will help you. You know, the order block seems to be like overwhelming to you, follow this thing and it will keep you in good trades, right? Especially, but you have to know, at least you have to know about displacements. This is where the market will just go up and leave these gaps, right? It likes to fill those gaps and go straight. Again, it will come down, fill those gaps and go up. So this could be like another combination that you might want to consider, where we have a low and a lower low plus a vertical structure, and then we do have a lower high, and then up to a new high, and then comes down. So as long as number 1 and 2 happen, doesn't matter, the order doesn't really matter, then you can consider it, especially after you see this displacements. For example, now you'd set up your trade when the actually you would set up your trade when you saw this candle coming down, right? You'd set up your trade from the lower high to the new high, and your 0.62, that's your entry always, and your lower high right there. I'm saying always because sometimes the market will come to 0.5 and go. I mean, there's some there is sometimes, like for example, this was a good candidate for the market to only come down to 0.5, but I'm just gonna have to leave that to you. For me, my entries are always at 0.62, well, most of the time, and right there you already know the game. 0.5 is my take profit area, and then I get rid of this right here because we want to see clean charts. But when I'm in a trade, in a live trade, I leave it on for the sake of clean charts. I'm gonna take it out, and then the market comes down, takes you in, gives you a little bit scared. You're scared, but you have to trust in your analysis and your plan, and it proceeds to go all the way up. At this point, you're looking at 2.8%. That's good. And you're flying, you're flying. 80% off. Boom. And this one did not take you out. Actually, yeah. So at this point, you should have been out of this, because I'm assuming it would have put your stop loss right there. But even if it doesn't take you out, you already took 80%. And if it takes you out, you're good. So 80% of 3.2, that's good. That's over 2.5%, I believe. And that's bingo. So that's the game that I gave you right there. Number one, time. Right? Time. Watch the 11 a.m. and sometimes 12:30 maybe. But this is kind of where I've seen most of the trades from, right? If you get a good setup, take it. If it loses, that's okay. Just journal, write down what you think might have been the problem, whatever. And that was it. Don't forget to leave a comment below, of course, like on this video, and let me know what you think about it. If you have any questions, let me know, and I'll be happy to answer them all. So that was Trader Mawira, and I hope you enjoyed, and I'll see you on the next one, and I'm out.